So I want to thank you, BUIDL, for having me here. I'm a US-based venture capitalist, and so I thought today I would talk a little bit about my thoughts on the market and the environment, and also what I look for in new projects. So I thought I would do that through two stories. So the first story starts with me and is my investing journey. So these are some of the companies that I had the good fortune of investing in the past 10 years. My investing career started around 2007, and during that time, I invested in some companies here and was also able to invest in other great companies. But here's the rub. I also invested in probably 300 or 400, if not more, companies that aren't here. So building something great is really hard, and it's easy to look back and say, hey, it's pretty easy, but the reality is these 7 companies are out of maybe 300 or 400. And it was also a time when the iPhone launched, and it created a lot of momentum for US-based investors. And around 2012, I invested in Coinbase, and that's when I first learned about crypto. And during that time, I was able to invest in other crypto companies listed here. For this audience, I've invested personally in Terra and Carry. I also invested in Corbett. So it's great to be here as a Korean American, to be a part of this community and to speak to you and to meet some of you as well. So I mentioned a story. Like I said, I started my investing career about 10 years ago. And I will never forget this day. And for those of you who remember and who were there, 2008, the fall of 2008 was probably I would say, the biggest disaster in US financial history. It was right around the time when the subprime mortgage crisis hit and banks were falling apart. This is a headline from the New York Times. This headline right here, next step is uncertain. That is unprecedented. That's basically saying the risk of what happened, it's really hard to overstate this. What was at stake was that mom and pop would go to the bank and try to take out money, and they wouldn't be able to take out money. Not because they didn't have the money, but because the banks didn't have the money. Ben Bernanke, the federal chair at the time, he said it. That time was the worst financial crisis in global history, including the Great Depression. And that was at the macro scale, and I was just starting my venture capital career. So what did we do? On October 7th, 2008, we sent a letter to all of our portfolio founders. For those of you who remember, that RIP Good Times is literally a slide that Sequoia Capital, probably the leading venture capital firm in the world, sent to all of its portfolio companies. The death spiral, that was one of the slides as well. They sent it to all of their portfolio companies, basically saying, party's over. I distinctly remember on that day, October 7, 2008, I was sitting in my partner Ron Conway's house, and we were drafting, and I was overlooking San Francisco, and we were drafting the email that we sent to the founders, effectively saying, you would be unable to raise money, and the chances of your success have dropped by about 100%. So when people talk to me about the bear market we're in today, I think of this time always, and being there is really something that will never leave me. And that's something, it's very different than reading about something than actually experiencing it. But what did I learn? Out of those ashes, you saw some founders who really started to work on what they wanted to create. Ben Silverman, Pinterest, started in 2009. It's now valued at $12.3 billion. What I learned from Ben is the importance of extreme focus. Ben wanted the world to have what he built. He had an impatience and a patience at the same time. He would have built and started this company in any environment. Jack Dorsey started Square. He had already started Twitter. He left Twitter somewhat unceremoniously at the time and wanted to build this company. It's now valued at $27 billion. Travis Kalanick started Uber, 2009, now worth $120 billion. Unfortunately, I didn't invest in that company, but that gives you an idea of the types of companies that started in this type of environment. And relevant to this crowd, one takeaway, and something that I won't ever forget, is that these companies raised, I would say, at max, their first round of financing, $5 million. And I say $5 million because Jack raised around that amount of money, and he was able to raise any amount of money he wanted because he's Jack Dorsey. And so what that told me was that being lean with your first amount of capital, raising what you need but as little as you can, creates an important constraint on creativity. I have never in my career, over 300, 400 companies, seen a company that was overcapitalized and have gone on to do well. So because what I've learned over time is that whether you're a human being, a company, a project, an enterprise, you spend what you have. You raise $2 million, you're going to spend $2 million. You raise $4 million, you're going to spend $4 million. You somehow, your salary goes up from $2 million to $4 million, your house gets bigger, your car gets nicer. That's human nature. And that constraint can be devastating to something that's just starting. So of course, for this audience, another enterprise or project that emerged from the financial crisis was Bitcoin, 2008. And I learned about Bitcoin around 2011 from a good friend who now is an executive at Coinbase, and thought I was really smart. Bought a lot of Bitcoin in 2011, 2012. I also had the good fortune of being an early investor in Coinbase, 2012. I was on top of the world. I learned, okay, I came from the ashes, but investing was easy because from there it was just up and to the right, not just in the markets, but also in crypto. So what happened? So around January 16th, 2016, my knees started to get a little wobbly. And for those of you who remember, around that time, Bitcoin was going through somewhat of a constitutional crisis, the block size debate. It was around late 2015, and developers were writing competing blog posts, slinging mud at each other, and I distinctly remember on this day reading this blog post by Mike Hearn. Mike Hearn was a core developer for Bitcoin. He also was an ex-Googler. I worked at Google, so I held him in high regard. And he wrote a post about why the Bitcoin experiment failed. And I read that, and I will always remember this quote. And I read that, and I used my pattern I thought I was really smart. I used my pattern recognition, and I said, it's over. Because this is founder fighting. I can tell you from my experience that startups fail for one of two reasons. You either don't have product market fit, or founders start fighting. And this I saw, and I said, founders are fighting. It's over. And I equated a developer community with a founder community. And so I'll talk a little bit more on that later. So I sold everything. I thought I was really smart, bought a ton of Bitcoin at 200, sold it at 450, doubled my money. And we know how that went. So from that crisis in my head and from my panic, what emerged? Two things emerged. The first thing that emerged was that the bug of Bitcoin, maybe this infighting, was actually a feature. It created almost by accident a certain stability, which correlated, some people think, to this idea of Bitcoin as a store of value. And the second thing that emerged, or the person that emerged, was Vitalik. And so that is something that everybody here in the room understands and lived through that rise of Ethereum launching, the ICO boom, enormous wealth being created, and exciting projects being created as well. So that's a second example of when there is a crisis, as Winston Churchill said, you never waste a good crisis. And of course, I panicked. So that taught me a bull market teaches you nothing. A bear market gives you a PhD. And that's something that I told myself, I'm never going to repeat this mistake again. So given that, I thought I would offer some final words or perspective on where we are. I'm going to talk a little bit more about what I look for. So one of the things, I was talking to somebody last night, and I said, you know, it's counterintuitive. When it comes to startup investing, if you're an investor, the only thing that matters is share price. You read a headline, company X raised 50 million, and they're now valued at $1 billion, that means nothing. You don't know about the dilution, you don't know about the option pools, you don't know about the ratchet, all these technical concepts that I won't go into here. The only thing that matters is share price. So if you look at Pinterest, 2010, its share price was a penny. Today, its share price, according to Equidate, is $7.18. That's 718x if you invested in Pinterest in 2010. That is a home run. Every venture capitalist dreams of this type of outcome. Now, look at Bitcoin. Obviously, this is not apples to apples. But even at this price of 3,000 and change, Bitcoin was a penny in 2010 when it first started trading on an exchange. It's now worth 300. That is a return, if you held, for 378,000x. So what's the lesson here? Obviously, this is a proxy for some of the principles that I think about. The proxy here is, or the lesson here for me is that when people tell me, and I've heard some people even on this trip tell me, we're at the bottom, we're in a bear market, and I ask why. The same question. I don't know why Bitcoin went up from 2016 to late 2017. I also don't know why it went down. But to say that it can't go down from here, I don't buy it. I look at this graph, because if you look at the Bitcoin chart and you zoom out, and if you told me in 2010 that Ohio in the United States will take Bitcoin for tax payment, and if you told me that the Bitcoin and Ethereum ticker would be on CNBC, I would say, give me that all day. But for whatever reason, because our frame of reference is always what happened in the last year, we think we're in a free fall. So to sum it up, I have no idea what to think about the market. I know that it could go up, I know that it could go down. And that is something that's outside of my control. But what I do know, and if I were to bet, I would say it's going to go down from here, just from looking at this. But that's somewhat irrelevant. Well, it is kind of relevant, but because the more important concept, now what's important to look at here, both of these graphs are 8-year graphs. Look at this graph. This is a 20-year graph of Amazon. So Fred Wilson sort of stole my thunder, and he talked about Amazon in a recent blog post, and he talked about the volatility in short windows. But if you zoom out and you look at Amazon over a 20-year period, it looks like this. And when you think about a 2-year period as a short window of time, that provides a lot of perspective for where we are today. It could go up, it could go down. The key is you have to be a long-term believer in whatever it is you're working on. Whether it's Amazon, whether it's a project, whether it's crypto. I happen to be a long-term believer. That's why I flew over from the States to meet a lot of you and to participate here. But you have to have patience. And that brings me to the second question. So a lot of people ask me as an investor, whether it's crypto or startup, what do I look for? And so the second story, so the first story was about me. The second story is about Michelangelo. So many of you recognize this. It's probably one of the most famous artistic images in history. It's on the Sistine Chapel. And the story is Pope Julius II asked Michelangelo to paint the Sistine Chapel. Michelangelo was a sculptor. He had never painted anything. And secondly, it was also fresco painting. He would have to be up on the ceiling, painting with fresco, which is probably at the time the most demanding way to paint. So initially he said yes. And then there was a lot of turmoil. He and the Pope had a falling out. He left Italy for a while and came back. It took him 4 years to paint this. And finally, he and the Pope reconciled. And when the Pope saw this image, he said, that to me, he was so touched. He said, that is proof of faith for me. And so when I think about what I look for Michelangelo. And the mistake that I made, so I adjusted my thinking from what I thought I learned in 2016. From what I learned in 2016, I thought what everybody is building here is very different from a startup, that you have to look for different things. But I've learned in meeting a lot of you and working with a lot of teams, whether you're trying to build Square, or Pinterest, or a sushi restaurant, or a sports team, or a great protocol, it takes an enormous amount of patience. It takes an enormous amount of focus, and it takes an enormous amount of discipline. And so when I look at and try to evaluate teams, I don't look necessarily, I'm not qualified to look at the technical details. I don't necessarily believe in having a thesis where I invest, because I invest in the very early days. And I would contend that any project in crypto, that's the lens one needs to have. And what I look for is, I look for people like Michelangelo. This is a quote of his that we have in our office. It's my favorite quote. And it's one of the things that I believe is really sort of misunderstood. Everybody who's a founder, they want to be Jeff Bezos. But very few people are willing to do the things it takes to be Jeff Bezos. Everybody wants to win. Everybody wants to build. But very few people have the patience to stick to it for a long period of time, through good times and bad, because it's something that they're passionate about. So what I would offer to this audience is this. Anytime you think about where you are in this cycle, because it could get a lot worse than where we are today, think about this, because I'm a long-term believer of everything that people are working on in this room, but I also have learned the hard way the importance of being patient. So thank you very much, and thank you for having me. I don't know if there's time for questions, or I don't know if June's in the audience, but if anybody has questions, I think I can take one or two questions. All right. We'll have fun. Oh, one question there.
Thank you for your speech. It was very nice. Can you tell me your, how do you say, criteria of investment other than the things you said?
I mean, for me, I use the same. I think it's critical that I meet the people and I meet the team and I spend time with them. And if I can't do that, it'll be very hard for me to invest. Because I do think that's the one thing I've learned, is that developer communities are very different from founding teams. The dynamics are different, the governance is different, the network dynamics, the human dynamics are different, but they're all human driven. And so I need to spend time with the core members of the team to understand the problem they're trying to solve, why hasn't it been done before, and the timing. I mean, that's the most important thing in investing, in my opinion, other than the team, is timing. Everybody's right. Everybody knows that, you know, especially in this room, everybody thinks Bitcoin is going to be important. Everybody thinks Ethereum is going to be important. Everybody knows that we're going to have self-driving cars. Everybody knows that we're going to be able to understand our health at a level, at an unprecedented level, because of genomics and advances in genetic engineering. The most important thing is timing. It doesn't matter if you were right and you were 5 years too early. So for me, I need to spend time with the people to understand why the timing is right and why they are the right people to work on the problem. So I know it sounds like a fortune cookie message, but in my experience, a lot of investing and working with teams is these pretty broad principles that are very difficult to apply. Because if you have too narrow of a lens, like I'm speaking, people talk about, okay, what's going to be important in the next 2 years, and that is really that's really hard to do, and I don't think, there aren't many people who have gotten it right. So that's the approach that I generally take.
Oh, cool. Great talk. So one of the things you talked about was how the economy really, I guess, grew from 2008 until 2018. And you talked about a lot of really successful companies that were founded in 2009 or so. At what point did you feel like these companies that were founded in 2009, which was a bear market, would be around for the long term? Because right now, we see in the crypto space, we're also in a bear market, so to say. And so at what point would you also be able to draw that conclusion that these companies in this bear market will be around in the next 10 years?
You know, a lot of it is, it's sort of like in the US, the Supreme Court talked about pornography, and they tried to define pornography, and they said, you know it when you see it. Because, and that's important because there are a lot of companies that you think are going to be great, and a lot of investors pour money, these billion, $5, $10 billion companies, and they're not even worth a t-shirt. And so the quick answer is you have to, that's at a point, that's when you start looking at the fundamentals of the business, because you've moved beyond product market fit, you've moved beyond the earliest stages, and now you're trying to build out your defensibility and not just have a business model, but also just to build a system and build a value chain around that. And so once you start seeing that, and then also I think one similarity with crypto and some of the businesses that I mentioned here are the network effects. And once you see network effects start working, you have to understand the nature of the network effects and whether or not those are durable. Because you know, there's a famous quote of networks, there are a few. So what looks like a network effect, you know, for every Facebook, there are a lot of companies that had the same growth rate and the same engagement, but they're a footnote. And so it's really important at each stage to understand what's happening and look beyond the first level of the data that you're seeing. All set? Well, thank you for having me.